Welcome back to Mortgage Giants. I'm tall, he's taller. Let's talk mortgages.
And obviously, we've really made some improvements here. The budget is skyrocketing.
After 3 episodes, the money's coming in.
Yeah, we've got a few subscribers.
We're rolling.
Myself, yourself, my
People
mom
in the office.
Yeah, so the sponsorship dollars have just been pouring in. So the studio gets upgraded.
That's right.
We're reinvesting.
That's right. Which is what you got to do. You got to reinvest.
Yeah.
Don't spend it.
Yeah. No, this is a shout out to my dad. Gray power, the retirement energy,
right.
focused, honed into good use here, and he's done a great job of building a sign for us. So thanks, Dad.
Thank you. Yeah, it looks good.
Yeah. So what are we talking about today?
Well, first, I wanted to go over how, at least in my opinion, we shouldn't use porting as like the main safety for the future. Like, I don't want to just rely on porting if something comes up, if we know that you might be moving in 3 years, we should plan more towards getting a shorter term, because I feel as though porting brings on more complications than benefits.
Yeah.
And so the reason that this came up for me is a client recently wanted to port their mortgage, and the property that they fell in love with was an age-restricted property that the lender was not having. So they said, no, but we love you as a client. So he has the decision to move forward with the property, but break the existing mortgage and we go to a new lender, or he stays with the lender and finds a new property.
Yeah.
So to just rely on porting while it is a very odd specific thing that could come up, you still don't want to be stuck in that situation.
Yeah, the age restriction is a common one. Not all lenders are okay with age restricted properties, as well as acreage properties.
Yep.
If there's you get to a certain land size, then that also becomes a problem. And you may not be able to port your mortgage from the residential urban home to the recreational or rural property. So that's another one that comes up often on the porting conversation.
Yeah.
And like we always try to. The deal is on ports is that you're always trying to avoid a penalty.
Yeah.
So that's the goal of porting. But sometimes a penalty is an inevitable occurrence in buying and selling real estate. Yeah. So it's just how do we minimize that?
Yeah.
Sometimes taking even if you take a 3-year rate.
Yep.
You're saying, I'm pretty sure we're going to move in 3 years. So I don't want the 5, I want to take the 3. If you sell in month 30, 6 months shy, month 33, 3 months shy, there's going to be a penalty. It's likely going to be a 3-month interest penalty, which is the lowest form of penalty that we're always trying to aim for. But the odds of actually syncing up a sale to line up totally on or a day or two after your renewal date is very challenging, because now you're working at another family's timeline.
For sure.
So that's really challenging.
For sure.
So that's generally when somebody's talking about a move is likely. We do talk about variable rate mortgages. That is going to often lead to the lowest penalty in the future. So there's that. But
another possible one is like builders who get red flagged. So I have had in the past where the lender said, we will not work with this builder. We love you as a client, but we won't work with this builder. So again, the client is faced with a decision. And there's no way to predict that, because we don't have a list from the lenders from the beginning of like, these are the builders they won't work with, or these are the types of homes they won't work with. So you do run that risk of just rolling the dice and like, maybe the port works out, maybe it doesn't. I just don't like the idea of planning on it. Like, I'll just take the 5-year rate. Who cares? I'll port in the future. I just don't like that aspect of it. Like, we should have the full discussion and really plan it. to make sure. We can always try for the port. I'm not saying we don't try, but these types of situations can come up and throw a big curveball.
Yeah. And the other challenge with the porting, and let's say the property is great, you're going from urban center to urban center, just a couple blocks away, you're upsizing a little bit, and now your current mortgage component is 375,000, and now you need to go to you need to add another 250,000.
Yeah.
The way that lenders port and increase, port, blend, and extend, all very different.
Yeah.
So that might not also work for your budget.
Yeah.
So now what some banks might try to do, and their policy is to say, no problem, we are happy to place this $375,000 on your new home.
Yeah.
You have 12 years left remaining on that amortization. We're not going to touch anything. We're going to port it.
Yeah.
True sense of the word. Nothing's changing. That is now going to follow you to your new house. Congratulations. Now let's talk about that 200,000 you need.
Yeah.
That's going to be at today's rates. And that's going to also start a new amortization schedule. Now that's going to create a secondary payment. So now you're mortgaging 575,000, but at 2 payments. And now those 2 payments might not be manageable for you.
Yeah.
You actually need all 575 at a new starting point, a new amortization of 20, 25, or 30 years.
Yeah.
So sure, they're happy to port, but are you happy with the payment situation that's created for yourself?
Right.
So now you followed the plan, you ported it, took advantage of all the privileges, but it doesn't work for you.
Yeah.
So that's a common one too. So,
and even in that situation, there's another potential issue for the future is if you have 2 separate portions, they're not lined up on renewal dates. So now there's no way to escape a penalty if you were to switch away from that lender. 2 different renewal dates, one of those you're going to have to pay a penalty on when you leave.
You're in this perpetual renewal state, and it just sucks.
Yeah.
Like, it really does. So if you do find yourself in that situation where a port works and maybe the new amount of money you need is a smaller, 50, 60, 70,000, great. But I would always try to sync up those renewal dates to get coterminous.
Yeah.
So that when the bulk of your funds are up for renewal, you're able to roll in the new second piece into one nice tidy mortgage, because nobody wants to be renewing their mortgage every 2 years.
Yeah, exactly.
It's not an enjoyable process, and avoid it.
And there's also the element of the porting window, as we call it, because not every lender gives the same amount of time. And let's say you're moving from one province to the other, and this mortgage closes, paid out, you might only have 30 days to find the new home and put that mortgage back on it, which is a tight timeline to do all of that. So if porting is in the future and you are confident that you want to port, we might have to adjust our initial decision on lender based on that, which means you might not get the best rated. Like there's so many factors to throw in there.
Yeah, factors that we're dealing with today. There's nothing really preventing us from dealing with updated policy changes, and it's always changing.
Yeah.
So what's true today might not be true tomorrow. So planning on it, planning on ports, planning on things like that are going to be a challenge and may not always work out.
Yeah.
We're also in a high interest rate environment today. We're recording this, end of August.
Yep.
There's a good chance that you might want to just blow up the rate you have today, which is going to be in a 5% situation.
Yeah.
If rates are in the high 3s, low 4s in 2 to 3 years, we would run that penalty calculation and say, well, it'll cost you $11,000 to get out of this mortgage. But if you're paying 1.5% lower on the new mortgage, you will recoup most, if not all, or more, via interest savings. And so don't feel too bad about it.
Yeah.
So that's another calculation that should always be done for you, is to understand penalty, yes, but if I'm moving into a better interest rate situation, I will recoup.
Yeah, exactly.
Yeah. So
planning.
yeah. Yeah. And again, we're not even factoring in porting of CMHC or insurer
Right.
guidelines.
Yeah.
So let's talk about that. There are buyers,
Hmm.
there is a mortgage, there's a property, and then there's insurance.
Yeah.
There's kind of like the four pillars.
Yeah.
You can port an insurance premium. So let's say you bought your house and you put 5%, 10% down. You've paid that insurance premium. So you have an insured mortgage, means you get a better interest rate. Have we talked about that? The difference between insured mortgages and conventional?
We haven't yet, not on here. Nope.
Man, so much to talk about.
Yeah.
We'll
Maybe
unpack that
another
one
episode.
later.
Yeah.
But you pay the insurance premium. That premium is attached to you, the buyer, the homeowner. And if you want to move to a new home and you originally put 10% down, you want to go buy a new home, put 10% down on that one, they will port that policy over to the new property. So that will save you a significant amount of insurance on the new property. So that's a positive.
Yeah.
The downside is you generally have to keep the same amortization.
Yeah.
So you're stepping into a shorter amortization than if you just repaid the new premium.
Right. And if you're upsizing, then shorter amortization
might be a pinch.
Yeah.
Yeah. So, but again, you can port the mortgage, you can port the mortgage and premium, or you can just port the premium. So that's some analysis that probably just the general consumer is not going to be able to understand or do. So definitely important to talk to the broker about that and say, hey, well, okay, my rate kind of sucks. I'm not a fan of that mortgage product, or I could care less about that bang. But what about this premium? Let's talk about porting that. And that should always be a discussion.
Yeah.
And probably not had all the time.
Nope. No.
Yeah.
I don't think the depths of porting are discussed.
Yeah.
I think clients like, is it portable? Can I move it? Well, yes, if you want it in the simplest form, but this, and this could come into play.
Yeah.
So.
Yeah. Yeah. So I would say that more often than not, apart from obviously an age-restricted building or a unique property style like acreage or log home or something like that, it's often the shorter amortizations that squash the viability of a port.
Yeah. Well, because very rarely is somebody keeping everything the same, right? Very rarely are they buying the same price house and the mortgage is staying exactly as is.
Yeah.
Generally, they're upsizing or
they're moving for a reason.
Yeah.
So and it's common. Maybe switch a neighborhood, school district. They don't need more space. They just need a different neighborhood.
Yeah.
But it's confusing, it's challenging. You need somebody to help.
Yeah, exactly. That's why you get a broker. And then what is it that you were mentioning before we started?
I want to talk about the story.
Yes.
The human element.
Yeah.
That comes up because we are in a verification audit style business where we understand a client's goals.
Yeah.
We know what they're trying to achieve, and then we're collecting the documentation to support the financial feasibility of a purchase.
Yeah.
So we're very much, it can be black and white. I mean, we need this much income. This is how we verify that income. This is how we verify the down payment requirements. This is how much down payment is required. So that's all very mathematical.
Yeah.
But there is also 1, 2, or 3 humans involved, and they all have different situations, different histories, different credit scores, different employment styles. So now how do we explain that and add the human element to that paper?
Yeah. Yeah, like one thing that I could think of is, say you happen to be partnered with somebody who left you with bad debts, kind of a bad situation, credit got shot, you've got to kind of dig yourself out of this hole, and now you're working your way back to getting into home ownership on your own. There is a story element of, okay, the credit might not be great right now, but look at where it was, and look at what they have been able to do to pay off this debt, show current amazing repayment. And since they've gotten out of that bad relationship, now there's a story to reflect the positive upswing
Yeah.
versus just like, yeah, I just kind of wasn't good with my money. And now I've got, like, there's a story that helps push this file through
Yeah.
versus like, not really a good explanation of things. You just let things slide. Like,
Yeah, separations are a big one. And I mean, obviously, financial stresses cause and lead to separation. So, yeah, if you had a partner that really did kind of drag the joint debts,
mhm,
through the mud, and you suffered for that. And if we can show that, because if you look at a credit report, we see monthly repayment.
Yep.
For a couple of years, we see on-time payments. So if there's a break in time where all of a sudden, separation happened here,
yeah,
and then repayment started, yeah, that's a great explanation.
yeah,
Also, I mean, if there's a job loss,
yeah,
you can look at their employment history and say, this individual's been working at their new job for 18 months.
yeah,
There was a gap. There
mhm,
was a 4-month, 5-month gap in employment.
yeah,
And that's when some problems occurred. That's when a late payment happened.
yeah,
But since then, there's been strong repayment history. That's the story we want to know.
right,
So um,
yep,
transferring, moving
yeah,
inner city to city. Sorry.
yeah,
All those things add to the story
for
and
sure.
can help mitigate the yellow flags that we see on a file.
Right. Because, yeah, if there are multiple job moves or you're moving constantly, there's going to be a question from the lender of why
Yeah.
is this happening? And do we have a reasonable story? Like, I've had clients who work for big companies that have multiple branches all over the world, and they took every opportunity. They worked in Texas, they worked in the UK, they worked in BC, but they were all with the same, like, there's a reason. Like,
Yeah.
I get a job popped up here in BC. Would you like to go? Yeah.
Yeah,
I want to experience.
what a different story than a new employer,
Yeah.
every 8 months.
Yeah,
Yeah.
exactly. So story has a huge impact, but it's not like 2 + 2 is 4. Like, there's got to be,
Yeah.
it all needs to come together and
Yeah.
really show that this is what's actually happening. We can't just say you've done it.
Yeah. Well, and even story, can go the other way. If somebody's been renting, their first time home buyer, and they're renting for $1,200 a month. They want to buy a place, their mortgage payment, taxes, everything's going to go up to $2,500 a month. They have no personal savings. The down payment's coming from parents.
Mm-hmm.
So the bank catches that. Like, they will say, okay, well, this person's been paying 50% of what their future bills are going to be. They've saved no money for down payment.
Yeah.
What's the story here?
Yeah.
And if we don't get ahead of that,
Yeah.
if we don't include that story on the rationale behind how this purchase makes sense, they're going to come up with their own conclusions.
Yeah.
The bank is going to be like, I don't see it.
Yeah.
Next.
Yeah.
They push paper all day, and it's important for that file and that explanation to be there before they ask it.
Yes.
So yeah, I mean, in a situation like that, it's like, yeah, this applicant, recent promotion, graduate, the income is also significantly increased over the past year, and their sibling is going to be moving in. It's
Right.
a joint, they're still finishing university, and the family is going to help support. They qualify.
Yeah.
So that's not a concern. It's just the reasonability of why all of a sudden are they buying a home.
Yeah.
Tell the story.
Yeah.
Yeah.
And then there's times where the story can lead to finding out the client may not be in the position that they tell you that they're in. Right? You have the initial call, you ask about credit and everything, like everything's all good. And then you look at it and there's multiple lates over the past few years. Like, no, I paid everything on time. It's like, unfortunately, not from the records that we are seeing. The story just doesn't line up.
Yeah, reality.
Yeah.
Yeah, when reality is presented.
Yeah.
Yeah. Yeah, that's the hard part. I would say people think that they're not sure about what we uncover,
Mm-hmm.
and then there's where they're always trying to push that limit a little bit.
Yeah,
Honestly, honesty is the best policy in this.
for
We
sure.
do uncover everything. Getting on a mortgage in Canada is very challenging,
Mm-hmm.
and we do have to have full disclosure.
Yeah.
Um, with all of the tools, all of the information, we can usually make a case
Yeah.
for a lot of things,
Yeah.
a lot. But if we submit something and then something comes out later,
Yeah.
something that was not told to us, then all of a sudden that just puts a bad taste on the entire file.
For sure.
And if it was just addressed and disclosed originally, not a problem. Now it's a problem.
Yeah.
It was obviously kept.
Yeah. And they're also like, we're not here to judge in the sense of making
No.
you feel bad. Like, I'm sure there are brokers out there that have made people feel bad for the decisions, but it's more about like, here's the situation that you're in. Here's what we have to do to get you into this home or get you to refinance. Let's get that done if we can't do it right now. But I'm not saying that you did
No.
something horrible. Like, it's not about
Yeah.
judging you and making you feel bad, but we will be straightforward and let you know what we need in
Yeah.
order to move forward.
Yeah. That's so true.
Because
Yeah.
like there's definitely, I've heard stories of people saying that they've had bad experiences and this person made me feel bad about it, so why would I go to a broker again? Well, they're not all like that. Like, you can't.
No, you need that coaching mentality of exactly like understanding what led us here and what's the path out.
Mhm.
And there's a timeline that comes out of that conversation, and ultimately it is a step in the right direction.
Yeah.
You do what you want, but obviously I would always suggest that you um, get working on it. Rip the band-aid off, have that tough conversation, and find somebody that's going to help you.
Yeah.
Yeah.
Exactly.
And not now. Like, it can, if you've had a negative experience, it's probably because that broker just wanted a transactional, relationship.
Yeah.
But if you get that relationship started where somebody's actually going to help you, and now it's a 2-year plan,
Yeah.
and I'm there with you the whole way,
Yeah.
I'm not going anywhere.
Yeah.
Like, we're here for you.
Yeah. You got a question 3 months in, we're still here.
Yeah.
6 months in. Like, it doesn't have to be just, all right, see you later. We're
Yeah.
not here anymore.
Yeah.
We're here to bounce ideas off of and
Yeah.
run through scenarios and can we make this work? If not, let's set it up for success in the future.
Yes. Yeah, absolutely. So, and when those ones come to fruition and that person gets the house, man,
So rewarding.
the best.
So
The
rewarding.
best. Yeah.
All right, I think that's a good place to leave it for today. So make sure to subscribe and check in next week for a new episode of Mortgage Giants.
Yeah, and I think we know what we're talking about. Let's talk about CMHC and
right.
insurance.
That's right.
Okay, great.
See ya.
See ya.